So welcome everybody to Path Home Team's first real estate webinar and seminar. The goal today is to really give a broad overview of investing in real estate, whether it's residential or commercial. Please be interactive on this. If you're joining us on Zoom today, please in chat ask the questions, and Nicole, who's monitoring that, will relay it to me. Because we've got such a small group, it's okay to raise your hand and interject if there's something you want to go deeper in on. And depending on how much time we have, I do have a lot of economic data at the end that we can review as well, just to give you an update on what's going on in the market. So if you can do the next slide. So a little bit about me. So my name's Pilkington. I'm the founder of the Path Home Team. My experience, so I started working at the age of 14, but I started doing construction even before that. We built our first house when I was in middle school. So I learned how to wire properties when I was in middle school and hang drywall and things like that. I actually did construction to pay my way through college. After college, I was actually a licensed stockbroker before graduating college. Part of that was I had my Series 7 and then my Series 66, which is a financial advisor credit. So I could actually manage people's money for a fee. I was a chartered mutual fund counselor, a CLU, which is a life insurance advisor, and it was all to help people avoid paying estate tax while helping them make as much money as they could in the markets. I ended up getting into investment banking after that. I was wooed away by all the money that some of my friends were making in investment banking. So I actually worked for Countrywide Securities Corporation, and we turned mortgages into bonds and sold those bonds on Wall Street. So if you ever saw The Big Short or read the book, I was at ground zero for a lot of that. I was the head analyst on $56 billion in mortgage-backed securities, to which after my wife and I had moved here, I actually got a knock on my door one night getting served so that I could be part of a $1.6 billion lawsuit against Bank of America and Countrywide, but I didn't do any wrong, and neither did the people that we worked with. And then I transitioned into real estate in 2008. I do consider myself and our team, we really hold ourselves out as real estate wealth advisors. Our goal whenever we're helping anyone buy, sell, or invest in real estate is to treat it like an investment, knowing that most folks, the most of their assets are in their real estate holdings. I've personally done over 800 transactions. The team's done over 2,300 transactions. I've done over 100 plus investor transactions. I was trying to figure out last night how many millions and millions of equity I've helped investors. I mean, I've got one investor alone that I think I've helped grow over 8.5 million in equity since we helped them buy their first properties. I've personally flipped 23 doors right now. And I've got a multi-million-dollar rental portfolio that I'm looking to actively grow significantly more. So a lot of the stuff that we work on is for the benefit of our clients. And of course, as a real estate practitioner, I'm very much putting my money where my mouth is and investing in the same things. So a little bit about my education. I did graduate with a degree in finance. I started as a chemistry major, decided I didn't want to be a doctor and go to school that long. I am part of multiple mastermind groups. And who here is familiar with what mastermind groups are? Who here is not familiar? Okay, Ryan knows. So basically, like a mastermind group might be, some of them are free, a lot of the really good ones are paid. And when I say paid, like they're expensive. It's anywhere from $15,000 to $100,000 a year or more, depending on the group that you're in. Yet the value you get from the group can be just incredible. So like the last event I was just at, just earlier this week in Nashville, we had the author of the book, The Banker's Code, come speak to us. Previous one before that, one of the books that I recommend people getting, Ken Blanchard wrote, he came and spoke to us. Another one on tax-free wealth, we had Robert Kiyosaki's accountant, Tom Wheelwright, come speak with us. And then you end up learning from people across the nation. So the Be Wealthy Mastermind is all about investment, tax, and wealth building. The Metrics Alchemy Mastermind, very similar. It's a fantastic network. And so even being part of investment groups nationally and having connections because of these masterminds, we have a very large network of investors that some of which are just just killers. They do so well in the industry and they're all across the country. The WGR Coaching Mastermind, I was able to meet one of the best wholesalers in the industry through that. And how that's important is that gentleman's acquiring about $10 million a month in real estate right now, and he's doing almost all of it with zero money down. Pretty interesting way of going about it. MAPS Coaching, so MAPS stands for Mega Achievement Productivity Systems. I was actually a coach for MAPS. It's Keller Williams coaching organization, and it's the largest coaching organization in the world right now. At one point, it was coaching over 8,000 people, I think at the top. I'm a CREE, a commercial real estate expert. I'm not a full-time commercial real estate broker. Though we are looking for actually to bring on a full-time commercial real estate broker, but I do work in the commercial space, primarily in multifamily and in warehouses. REI Game Changers is part of the platform that we're in, and Ryan is the one spearheading that for us in growing out that investment division. The Science of Flipping with Justin Colby. He's another one of the national flippers and wholesalers who I've had the privilege of learning from directly, and I'm a short sale and foreclosure resource specialist. And so why invest in real estate? What do you guys think? Why invest in real estate versus anything else?
It makes more sense than anything else.
It does make a ton of sense.
Appreciates with inflation.
You know, that's 100% right on.
Yeah.
Like you basically pegged the next slide that's gonna come here, or one of them. Anyone else? Why not invest in real estate?
Devil's advocate. The market's gonna crash.
Market's gonna crash. That's a good one. It's expensive to get into. Unless you know creative strategies, it can be very expensive to get into real estate.
Real estate is somewhat illiquid.
That's very, very true. Very, very true. Real estate's definitely illiquid. You can always sell real estate, but depending on where it is, it may take some time, or depending on what price you want to get for it. Even if you want to pull liquidity out, that may take at minimum 15 to 30 days. It's not the same as like a stock that you can liquidate and have your money in your account a day later, or even the same day. Mutual funds typically going to be a day later. But the things that we look at for why invest in real estate, the inflation adjusted returns. Real estate does incredibly well compared to inflation. When you look at a lot of other investments, a lot of investments actually lose money over time. So that long-term capital appreciation is fantastic. The rental income. So a lot of stocks will have dividends. Real estate has dividends in the form of rental income. Of course, there are some forms of real estate like land banking where you might just purchase a plot of land and then you're not making income from that. But most of the real estate that we focus on is income generating. Very generous tax breaks, depreciation, and anything you spend on it for improvements. And so, like, if a good example is if you need to mow the lawn at your property and you buy a new lawnmower, even if you use that for your house, you can deduct that as an expense for the properties. Leverage. This is one of the biggest ones, and it's one that often can scare people. Yet it's the way that real estate truly can outpace the returns of other investments. Even if you're conservative with your leverage, having a 50% loan, it allows the amount that you can invest to grow substantially, where when you're comparing that to a stock, for example, if you had $100,000 and it grows 20%, well, you made 20 grand, that's fantastic. But if you had $100,000 and you bought a property, even if you put 50% down, so you bought a $200,000 property, if it goes up 20%, well, you just made $40,000. And in most examples, people are really putting down about 20%. So that $100,000 would actually buy a $500,000 property. It goes up 20%, you just made $100,000. So the difference between investing in stocks and investing in real estate can be staggering, though, in full transparency, I am no longer a financial advisor. I'm not licensed anymore. So don't take any of this as financial advice. Please consult your accountants, any attorneys, and consult any financial advisors. And I do believe in a balanced portfolio with assets in the stock market, assets in cash equivalents, assets in real estate. So, and you can control it. Like a mutual fund, you can't really control what's coming in and out of it. You can very much control real estate, and real estate is very stable. Nicole had mentioned, like, what if it crashes? So, like, that's a great question. What are your guys' thoughts? What if real estate crashes and you own 10 rental properties?
People still need to rent.
Exactly. And unless you actually have to sell it, it doesn't matter.
Yeah.
It doesn't actually matter if it crashes down. And there could even be a benefit of tax loss harvesting should you choose to sell a property at one time to take advantage of a lower price point and roll that into another property. Or it's a great opportunity to pull equity out of your properties, because when the market crashes, everything's on sale. Like if we found out that everything at Best Buy was 30% off, it would clear the store out. When real estate's 30% off, it's crickets, except for people who are savvy investors. The Warren Buffetts of the world then jump in heavily. Okay, so building wealth. There's a couple. So I came from Keller Williams. We're currently with Real Broker, but I'm very grateful for some of the education I got from Keller Williams. And this came from the Millionaire Real Estate Investor book. One of the biggest things, I came from a very, very low income family. Like we had free breakfast, free lunch all the way through high school. I started working at the age of 14, so I could actually afford to get like cool Nikes and a shoe and like the jacket and stuff I wanted. And so a lot of folks who come from a background where they don't have the knowledge about wealth building or the knowledge about what it means to be wealthy, have a mindset that they can't become wealthy. And the reality is wealth is all about just making consistent decisions, consistent base hits over time. And some of these myths that people think is like, I don't need to be an investor, my job will take care of my financial wealth. Well, the vast majority of people will never earn enough money to keep up with the cost of living. And we'll get to that in a second. The value of a dollar now is so much less than it used to be, yet overall wages haven't necessarily gone up in most industries. The truth is, yes, you need to be an investor. Your job is your job is not your financial wealth. Second one, you don't need or want to be financially wealthy. I'm happy with what I have. I'm a big believer of creating a financial wall of freedom around the people that I know and love. As growing up not having health insurance, it's important to be able to protect yourself and the ones that you love. If you want to make an impact with other people, whether it's friends, family, people you don't know, whether it's giving any donations or anything, you need to have wealth for doing that. So open your eyes. You do want to be financially wealthy. It doesn't matter if you want or what you want or need. I just can't do it. You can't predict what you can or can't do until you try. It's very, very true. Investing complicated. A lot of folks stop at that one. The investing's complicated, which is why a lot of folks focus on the stock market, because all you have to do is put some money in and press a button or hand it over to someone, and they think that they can't do real estate because they may not have enough money right away. It's only as complicated as anything until you learn it. Before all of us learned the alphabet, that was really complicated. Before all of us learned our times tables, that was very complicated. Yet once you get comfortable with it, driving a car, same thing. It's only as complicated as you make it. Part of what we'll talk about is creating an investment buy box so that you're not trying to accomplish everything. I'll be the first one to say that I have suffered from the shiny squirrel syndrome of every opportunity that could be a great opportunity I want to explore. Yet the more you can focus on something that makes sense for your long-term investment goals, the better. Even if something else seems like it's a great opportunity, unless you're going to change that buy box, just go ahead and block it out, send it to somebody else so it fits their buy box. The best investments require knowledge most people don't have. Know your best investments will always be in areas that you can already understand, and partnering with people who know that to help you. Investing is risky, you'll lose money. Investing by definition is not risky. Speculating is risky. Investing is making a decision on an asset that is going to appreciate. Assets appreciate. We want to invest in assets. Successful investors are able to time the market. Successful investing, the timing finds you. Most people can never time the market. If you have the luck of selling at the top and buying at the bottom, that's what it is, it's luck. There's no one who's consistently timed the market over and over again. All good investments are taken. Every market has its share of good investments. What's funny about that is we have investors coming from the coast, California, New York especially, and they're looking at our investments here and they're like, oh my God, this is double what we're getting. Meanwhile, we have people here who are like, this is garbage, like everything's too low, like the prices are too high, the return's too low, let's go somewhere else. Like Ryan and I were having a conversation in Kansas City, and we're looking at an investment and we're like, oh my God, this is like a 15 cap rate. And the guy's like, yeah, this doesn't really seem like a good investment, it should be better. And we're like, oh my gosh, this is like amazing for us. And so you just have to invest in the areas that that you're comfortable with and learn what that buy box is. So why you must really invest. Look at what inflation's done to the purchasing power over time. I mean, I was born like right in here. And it's hard to tell how much of a difference that is, but I mean, if something goes from 10 cents down to like 3 cents, that's an incredible difference just right there. I won't guess when you guys were starting there. So,
Oh,
good
I
plan.
knew President Roosevelt.
yeah, personally, nice. But you can see like the value of the dollar has gone down and it's going to continue to happen. And so in order to even keep pace, either you need to be earning more than the value of a dollar is going down, which is really hard to do, or else you need to be investing in assets that are going to help earn for you. the whole idea is that if you can earn while you're sleeping, then you're going to be able to get to a point where you're not going to burn out in life. If you never reach that, that's where burnout and really just feeling like it's futile hits in. Median sales price of homes. I mean, this is pretty crazy. I mean, again, going back to, like, I was born back here, median home price was in the 70,000 range, where now, even with the drops that have just happened, we still have well over $400,000 of median home sales price in the United States. And what's funny is almost every time that people have thought it's too expensive, and then there's a little bit of a correction or a huge correction, like look at here, this was the biggest correction we've ever seen before what may come or what may not come. And it only took a handful of years, we're right back up to where it was again. The fact of the matter is that homes are not being produced as fast as people are. So let that sink in for a minute. I mean, at some point, unless technology changes, the number of homes available will not match the number of people who need those homes. So.
Isn't that right now?
It's close, Bill. It's really close. It's depending on where you are. It really is. So.
I mean, we just went through a series where people were throwing money to get a house.
Mm-hmm.
5 or 6 offers are denied, and people are getting desperate. And I'm not painting this dire picture for them. I'm saying if somebody is throwing literally huge sums of money at you, we're already there. And Sandy made the comment earlier that inflation keeps up. We call it an inflation boat.
Yeah.
It's a house. It keeps up with, and if you drew the line of inflation on your previous thing there,
Yeah.
you can see that inflation keeps track or ahead of.
Yeah, very much. And we've got another one that's going to be coming up that I'm pretty sure does the same thing. So yeah, 100% correct. And so I'm going to go to the next one. And so home ownership here, hedge against inflation. And so here's your inflation in the blue. Here's your appreciation of home ownership. And to your point about how much people are paying for properties, there was a lot of people frantically trying to lock in a rate because most home ownership is payment driven. And what's interesting is right now people's payments overall are significantly higher than they were a couple years ago, even if the property is selling for less. There are ways to get around that, and there's ways to help buy the rate down and get a better payment. But that's what a lot of it was driving. I mean, that's why you had cars that were selling for $30,000 more than list price, or some cases way more than that, because people were just trying to lock in that really artificially low payment. Okay, so the impact of real estate ownership on net worth. Back in 1992, the median net worth for a homeowner, $122,000, renter $4,000. That means you had a $118,000 difference. Fast forward to where we are now, it's a $248,000 difference. And if you look at this, the average median net worth of a renter is only $6,000. When you look at like the prices of this, like they went up 50% from 92 to 2002, where real estate prices have doubled, went up 100%. And the next slide's kind of, go to the next one. This takes into consideration inflation adjusted. So $1 today would be equivalent to $2.12 in 1992. So, and what's interesting is you see that prices were higher and they dropped down here, or that median homeowner net worth dropped down, because this was right after that the crash. And this was still recovering from the 2008 crash. That being said, what's interesting is if you look at the median net worth of a renter, it's actually less because of inflation. Where when you look at the homeowner, it peaked out there, went down a little bit, down a little more, and then it's come back, and it's almost staying the same. And so even though the home prices have gone up a lot, the actual wealth you have hasn't necessarily changed compared to 92. It's just that you're keeping up with the inflation where the renters are still losing. And so the unfortunate thing is that there's going to be a lot of renters who never get out of that. So being creative and getting into real estate as soon as you can, doesn't matter what the market is, the best time to invest is as soon as possible, as soon as you can make it happen. Because I imagine this disparity is just gonna keep happening, so. Next. All right, so if you look at this is kind of crazy. So this is in Colorado, the amount of hours you need to work in order to afford a mortgage. 2015, it went from 43. We're currently at 80. How's that important?
Okay. I mean, it's important because there aren't gonna be people paying 80% on a mortgage that are gonna be able to afford a mortgage.
Yeah, half of your month of earnings, half of your hours is just going to pay your mortgage. And so the necessity for dual incomes, or the necessity for some form of house hacking to be able to supplement that payment, whether you're renting out a room in your house, something that we're really hopeful of is that Colorado is going to continue to work with ADUs to be able to add the accessory dwelling units. I'm a big fan of those, whether it's used for an Airbnb or even as an investor, to be able to take a single family house and then build a 1-bedroom, 1-bath studio or 1-bedroom, 1-bath apartment over a garage. As an investor, that just allowed me to add another unit to it for much lower cost than the cost of actually acquiring a 1-bedroom unit, because I don't have to pay for the land again.
And the government really supports that, right?
Some areas are, some are absolutely not. And so it's interesting because Lakewood's really into it right now. Lakewood's really supporting ADUs right now.
Really?
But Denver's kind of. Like they're getting like a little more into it. And Denver's also starting to encourage micro housing, where they'll take a lot that might be approved for a duplex or a quadplex, and they'll actually allow up to like 20, 30 micro housing units, where it's little tiny houses, little 250 square foot tiny houses. It's interesting because then that creates a whole other problem of like the sewage waste management system wasn't necessarily designed for that. So there's gonna have to be a lot of upgrades in infrastructure. But yeah, you're right. I mean, a lot of these things, they're not as easy to do as they really should be. And with material costs, it has definitely gone up. But I've actually been helping my brother and sister-in-law connect with people that just build ADUs. They've got their house in Lakewood paid off, and now they're looking to add that. And part of it's because they're my sister-in-law's father-in-law spends 4 months a year with them. As he's getting older, it doesn't make sense to have him in the basement. They're going to have him have his own space out there, and then the other 7, 8. He's a retired teacher from New Hampshire. The other 8 months a year, he's going to be out in New Hampshire. Then they're going to lease it out as an Airbnb, or even get a longer-term tenant in there. So, all right, next slide. So this is interesting right here. So in an inflationary period, what this basically shows is that you are still getting price increase above inflation, but it's not as much. But in a low inflation period, real estate housing really starts getting ahead. And so if the market is inflating a lot, housing isn't necessarily keeping 2 or 3 times up above it, but it is keeping above it. When inflation is not super high, housing is still growing more than inflation is. And because inflation is just such a hot topic right now, I mean, it's real. It's really real. Like, you go to buy eggs and it's like $8 a dozen, depending on what you're getting. You go to buy milk and it's a gallon of milk, it's hard to get for, especially organic, under like $7, $8 now. I mean, that's a lot more expensive than it used to be. So it's the cost of living is high. The way to offset it is by getting income from assets, and real estate just happens to be one of the best ones to do that, in my opinion. All right, the next one. So this goes along with the housing crunch. So right here in 2008, home builders stopped building, and they didn't really get going again until after 2010. So during that time period, the number of homes available is just declining. We currently have over 1 million legal immigrants a year coming into the United States. The population is growing at a rate that it's always grown, only it's getting bigger and bigger because of how many millions of people there are, hundreds of millions of people there are. And until there's new technology for constructing properties quicker, the current system can't keep up with the demand. We just went through really high prices of commodities from COVID. Everything got really expensive. Wood was really expensive. We already saw last fall, a lot of builders just stopped production. They're starting it up again. The builders are concerned about being stuck with inventory that they're not gonna be able to sell. What's funny is actually in one of those mastermind groups, when we were talking about builders potentially being able to sell properties at a discount if you go in and buy bulk, one of the guys by the end of the day on the first meeting called one of his local builders in North Carolina, offered to buy every property left in development and what kind of deal could he get, and they sold it to him for 22% off to buy 18 properties. Bought all of them, just done. Weren't even built. All of them had foundations in. The builders just wanted to get that risk off their plate. They were willing to sell those properties. Most home builders have a 10 to 20% margin on the build. They were willing to sell that for break even or a loss because they were concerned where it was going. Next. Should you invest in real estate or stocks? I think you should have both. They have advantages and disadvantages, but the thing with real estate is the leveraged returns in real estate are just incredible. So go to the next slide. So if you look at home price index and stock price index over time, this is just the value of a home going up on a dollar basis, on a percentage basis, compared to the stock price. That being said, you can leverage this 5 times or more. If you're a first-time home buyer or if you're an owner-occupant, you can buy a house with 0 down with a VA loan. You can buy a house with 0 down with a conventional loan. Many people use a FHA loan, 3.5% down. So if you're talking about only putting 3.5% of this price in, and then the rest of that is loan, homes on average appreciate higher than what your interest rate is paying, even with the interest rate today. And so, do you know what it's called? The difference between the interest rate you're paying and the interest rate you're earning, what that figure is between, you know what the term is? Arbitrage. The whole seminar that the gentleman spoke about with the Banker's Code was all about talking about how the Rockefellers have maintained the amount of wealth that they have. And it's very silent wealth, and it's all from banking. How much money do the banks typically have?
10%.
That's right. They don't have as much as you think. They have our money. They have the money that we use to put in deposits. They give us 1% or 2% for that, and then they lend it back out to us for 6, 8, 10%. Banks are arbitraging at the highest level. And so when you become a real estate investor, you're arbitraging. And we're going to talk about a couple of different ways to do that. All right, next. Here's an example of what the leverage investment with the mortgage looks like compared to a straight stock investment. So this was $50,000 with no leverage, $50,000 with a 95% leverage. This one's assuming a 20% rate of return per year. This one's assuming a 10% rate of return per year. When you look at 1 year, 2 year, 3 years down the line, so 3 years of 10% versus 3 years of 20%, with the same money, because of that 95% leverage, $253,000 in equity versus $86,000. I mean, that's a nice gain. I mean, gaining $26,000, that's fantastic. But going from $45,000 up to here, and the reason this is and you look at these balances, the one thing you do have to consider is that with real estate, trading out of a real estate is going to have more expenses than trading out of stock. It just does. I mean, there's buyer's commission, seller's commission, title insurance fees, where when you're trading out of stock, the stock commissions now are very nominal. That being said, the amount of money you make on the leverage here, it's incredible. So, any questions? Awesome. So, next. So, types of investing. So, I like to break investing down into 3 different categories: personal property investing, active investing, and passive investing. Personal property, it's just that. You're investing in properties that you're actually going to reside in. Active investing means that you're putting your hands to work. Whether you're overseeing a flip happening, you're actually doing work on it. You own a property that you're managing, even if you hire the manager. You own a short-term rental property. Where passive investing is, is choosing to invest your money as a lender, as an equity partner, as part of a larger investment pool. You can purchase real estate investment trusts, REITs, That's like a stock, a relatively liquid investment, unless you're with Blackstone and they won't let you get your money out. And so, next. Personal real estate investing. And this is where most people get involved in real estate investing. Live-in fix and flips. Who's ever done a live-in fix and flip? Meaning you lived in the property and you improved it over time. You didn't necessarily do it just for the goal of getting out right away, but you did it so that you could make that gain and you wanted to live in a nicer house. My wife, her aunt and uncle have developed, I don't know how many hundreds of homes. And in the series of like 39 years, they actually had 23 primary residences. Their goal was to stay in each one 2 years. They get that tax-free gain. Sometimes the offers, he's a builder, sometimes the offers they got were so compelling that they took it and didn't get all the tax-free gain. But when you live in a property, if you're a married couple, you can get up to $500,000 of tax-free gain every 2 years. So, I mean, you buy a property here for $600,000, you spend, let's say, $50,000 improving it over 2 years, doing a lot of that work yourself, and that $50,000 is just on materials. Let's say you're able to sell that property for $700,000 later. You have $150,000 potential gain. Let's say you end up netting $120,000 of that because of fees. That's tax-free gain. $120,000 of tax-free take-home income, that's usually about $190,000 of earned income. So when you take the taxes out, my goal for every one of my clients is to help make their number one expense taxes and then to help them zero that out. No other expense when you start earning more revenue should keep up with what your taxes will. There's a reason that billionaires pay less taxes than a lot of average individuals. And it's not because they're cheating the system. They're just utilizing what the IRS provides, utilizing things that the government's telling us to do. Live-in flips, you can, oftentimes it can be a great opportunity to convert it to a rental. Most rental properties, are you familiar with what down payments required for most rental properties?
20%.
Yeah, 20% for a single family home. For a condo or a townhome, it's usually more like 25% or even upwards of 30% depending on where it is. I mean, so that's a lot of money you have to put down. Where you buy that as an owner occupant, you can buy that for 3.5% down. And then what's funny is, and a lot of people don't even know this, is that you're supposed to keep a FHA loan for a minimum of 1 year. That being said, there are rules with with HUD where you can move out of that house and keep it as a rental, even if you don't keep it for a year. If you get married, if you get divorced, if you get a new job, if you have a baby, if you have a loss in the family, growth in the family, those are all reasons that you can move out of your house and keep it as a rental and move into a new property. And they won't call the loan, meaning they won't make you pay off the loan. So you basically won. You got into a property where you only had 3.5% down, and you're getting the same advantage as an investor, being able to earn that equity on it and earn that rental income. And house hacking. Who here has heard the term house hacking before? Yeah, it's been a very popular term for quite a while now. And a lot of folks don't necessarily know what it means. The two most common that I see is multifamily house hacking, where you buy a duplex, a quadplex, that's the best ideally, triplex. It doesn't usually work for anything bigger than that because the financing is now a commercial loan as soon as you're at 5 units or more. And then you're now in the territory where you do need to have that 20% down. But in a perfect world, if you buy a quadplex, let's say your mortgage payment is $4,000 a month and you rent out each unit for $1,250 a month, that means the 3 units you're renting out are $3,750 a month. You're only paying $250 a month for you to have a place. The best examples are the ones where you're renting out each unit for like $1,500 a month. You're collecting $4,500 a month to pay the mortgage $4,000. You're making $500 a month living for free in an asset. One of my clients, I think he's 33 now. He's a physical therapist. We helped him acquire he already had a triplex that he converted to a 5-plex in Baker. We helped him buy a quadplex. Him and his wife would live in one unit and fix it. And then as soon as a tenant moved out of one, they'd move into the next one, rent the unit they just fixed out for more, and they just kept doing that. Then we helped him buy a sixplex, and I know we helped him get one other property, and he does have a partner with some of them, but he was able to use the 3.5% down over and over again. So what was funny is that at the age of 30, as a physical therapist, he was earning more money on his passive income than he was as a physical therapist, who at one point was one of the physical therapists for the New England Patriots. Which I guess if you work for an NFL team, they don't pay you very much, unless you're on the field. So the other one is the single family condo and townhome. You rent out bedrooms. One of the smartest new agents I ever met, she was actually referred to me by her dad, who I'd done deals with. When I met with her, she was telling me about where she lived in Parker, and she bought a townhome that was a 3-bedroom townhome, 2-bath, and had an unfinished basement. They finished out that basement. Her mortgage payment with HOA and everything was like $2,700 or $2,800 a month. She ended up having 5 bedrooms in this house. She lived in one of the bedrooms, and then she rented out the other 4 bedrooms to 5 girls. 2 girls shared the master suite upstairs. She ended up net positive over $1,000 a month in rental income. So she had a property that most 23-year-olds couldn't have dreamed about, yet it's very attainable within reach when you structure it that way where you're bringing in that additional income. By the time I learned about house hacking, I had a pregnant wife, and she was not interested in any way. And so this is something that, even if like the multifamily one, this is something I'm gonna definitely do to help my children out. You can do it with your children, your grandchildren. The down payment for an FHA loan can be gifted. When you're qualifying for that property, you can qualify based on the rental income. So let's say one of my kids decides to go to college, and most college towns have multifamily properties. If it's not in Boulder, because it's out of reach in Boulder with the prices there, but if it's in a normal like town, I could gift them the 3.5% down payment. They could qualify for it based on the rental income. Move into it, manage the other units. It's a great way of getting people to understand what the real world is like. And instead of paying $1,000 a month to the university to pay for housing, you might earn money every month. And at the end of it, so this actually, I went to school at Pepperdine. One of my friends at Pepperdine, Kelly, she was fortunate enough to be able to buy a townhome her freshman year. She had inherited some money. She bought this townhome for $396,000 in 1997. She sold it in 2003 for like $950,000. I mean, she graduated college, had 100% of it paid for, and another $300,000 plus in equity afterwards. I mean, that was brilliant. At the time, it seemed very out of reach because I didn't know how to get into things like this. And so the goal is that everyone learns how to get into things like this, and then they can guide their family, friends, people they know. Active real estate investing. Most common ones are buy and hold long-term leasing, buy and hold short-term vacation rentals, land, which is land banking and land entitlements. Those are a little more complicated. Land banking is pretty simple. You're basically acquiring land with the goal that somebody else, the city, is going to grow out to it and want to purchase it. Some of the land bankers I know work heavily in California because California has requirements for 100% clean energy. So they're literally buying land for like $1 a square foot out in the middle of a desert, waiting for Walmart and these big companies to set up big solar farms on it, and then they're leasing the land back to Walmart. So Walmart doesn't want to pay for the land, they want to get the deduction every year. And so that's what land banking is. Flipping houses, of course, and then wholesaling. Who here knows what wholesaling is?
Buying the contract.
What's that?
Buying the contract.
That's correct.
You sign a contract with the owners or someone's trying to sell, get an investor or a builder to agree to the different price that the owner has.
Yeah, 100%. You're finding a consumer who's needing to sell, you're getting that property under contract, and then you're selling the contract to someone else. It's something that non-licensed people can do. Wholesaling takes a lot of effort, boots on the ground to find that. It's not easy to find properties that people are willing to sell where there could potentially be a margin in it. But that is an opportunity. And I mean, I know some people that are actively working on that as like their part-time job, even though they go to work on a full-time basis. Passive real estate investing. Stocks, mutual funds, ETFs. all related to real estate. Do you guys know what ETFs stand for?
Exchange traded funds.
Exactly, exchange traded funds. So it's like on the publicly traded exchanges, you have like a home builders index where it'll be 36 home builders all packaged into one, and buying that one kind of like mutual fund, that one ETF means you own a little slice of every one. Most people know ETFs because they buy an S&P 500 ETF that owns a little bit of each stock in the S&P 500. Publicly traded REITs, which you're just going to be able to buy on any Schwab account, Fidelity account. Private REITs. So here's two private REITs, Streetwise and Fundrise. They're not publicly traded, but you have the ability to invest in them. Some of them are accredited investors only, meaning that you really need to have an income of $250,000 a year or more, total assets of $500,000 or more, or liquid assets of $250,000 or more, then you can be considered an accredited investor, or it might be total assets of $1 million or more. Yeah, don't hold me to that one, I'll look that one up again. Crowd-funded real estate loans. There are organizations out there where you can lend as low as $5,000 to $10,000 to be part of a loan going to a bigger entity, where then you're earning a 7 to 13% return on it. It's very passive. The organizations that put this together are making a fee on top of it. The management fee is usually like a 2 to 4% management fee, and it's providing a service out there. Sometimes that service is for small loans, business loans. Sometimes, very often, it's for mezzanine debt, helping people complete bigger projects, helping them get down payment money. Private notes. This is one that a lot of folks don't know about. It's something that I've dove into a lot higher level, yet haven't really participated in much. Ryan here has participated in it. What was your experience with owning a private note?
It was a pretty good experience overall.
Mm-hmm.
I mean, you're the bank, so people are paying you to buy the house with interest in your pocket.
Yep. Yeah, exactly. It's a very, when I was taught about it, it was under the guise of it's a low noise investment, meaning you don't have to deal with tenants, you don't have to deal with termites, you don't have to deal with toilets. All you have to do is collect the check, and homeowners are more likely to continue paying that. Worst case scenario, if they don't, you can negotiate or restructure with them, or you can foreclose on them. One advantage of doing notes as well is the first year of income is income tax. Every year afterwards, it's capital gains tax. So your income, the amount of tax rate goes down. Most investors will get to the point where they're no longer being taxed at a 20, 25% rate. They get up to that 30, 35%, up into that low 40s combined. And so if you're in capital gains tax, that means it's 15% or 20%. So you can make more money because you're paying less taxes. One of them here, so you can actually acquire a note for cash flow. There's note exchanges, you can just buy a note. You can buy and sell notes. You can buy a note that has 5 years left on it, and maybe you're getting a discount, or you can buy a note that has 29 years left on it. This is the one that I'm more excited about: acquire a property and sell it with seller financing. When I learned about this, it was in a lot of parts of the country, the rental rate for, let's say, a mobile home that's a 3-bedroom, 2-bath rental might be $1,250 a month. That's a pretty reasonable rental rate. Well, if an individual wants to buy that property at a 9.9% interest loan, which seems like a very high interest loan, or at least it did 2 years ago, you can peg the payment at exactly what they would be paying in rent. Only a property that maybe you bought for $80,000, you can resell for $120,000, all because they're paying based on their rental payment. I know this can sound a little bit confusing. Does this kind of make sense? Buy a property for one price, and then you actually get up the price even though you may not even fix it up, just because the payment that they're paying would be the same as what they pay for rent anyway. And so from a consumer standpoint, if you can't qualify for a loan on your own, there's a lot of folks out there who don't have great credit, but they make good money. And what's interesting about this, so one of my mentors, he actually acquired a property this way, and the reason the investor was selling, he ended up buying like 8 properties from this investor. The reason the investor was selling is that he was tired of dealing with the tenants. And he had one tenant in particular who was just a thorn in his side. And so this mentor of mine, when he bought the portfolio, went to go look at the properties and actually had the chance to meet that tenant. And it was a mobile home on land The yard was trashed. The guy had done a bunch of stuff that just was really pissing off the homeowner, chopping down trees that he shouldn't have, had all these like truck parts and stuff, but he was a contractor. And when he met my mentor, he said that he was really upset about how the system was rigged against him and that he couldn't buy a property because he's a contractor and so much of his income comes in cash. And so my mentor said, well, my goal is actually to sell this property to somebody who wants to own it. Are you interested in buying it? And then he said, well, I'd love to. I can't though. My credit's too low. And the money I earn, a lot of it's in cash, so I don't claim a lot of it. He's like, well, would you be willing to buy it if I sell or finance it to you? And fast forward 3 years later, this guy now takes care of the place. He's painted it, he's cleaned it up. The difference in pride of ownership there, of being a renter feeling like he was getting stepped on versus now having ownership in it. And he was able to put down a 10% deposit, which for that property ended up being the example I said of buying a property for about $80,000 and selling it for $120. It's that example. And so he was able to put the $12,000 down, and he pays his monthly payment that's almost exactly what he was paying in rent before. Only now he loves the property because he owns it. My mentor got a $40,000 appreciation in gain, and then once you look at the entire payoff, he'll end up netting about a $230,000 return on an $80,000 asset that he purchased that he immediately got $12,000 back on. 70 grand into something that paid him back $230,000+. So the last one there is real estate syndications, private equity funds, and beyond. Who is familiar with what a real estate syndication is?
It's just a group of people that go in on different properties and purchase them, let's say a multi-unit property that costs $3 or $4 or $5 million.
Mm-hmm.
5 guys pitch in the down payment and know what they're doing.
Mm-hmm.
They do the same thing with a multifamily that you can do with a house.
That's exactly correct. Yeah, and usually with the syndication, an investor who's running the syndication will make they'll make what's called like an advisory fee or a management fee. The investors will typically get a preferred return. So the cash investors that put their money in are typically getting somewhere between like a 7 to 10% guaranteed return. They may not get it in the first 12 months because usually the first 12 months is when they're investing a lot of money in improving the property. Yet they usually identify the property before everyone's money is finalized. So unlike buying into like a mutual fund or a REIT, you have no idea what you're buying into. In this one, you'll actually get a pro forma on what the property looks like now. Do you guys know what a pro forma means? It's basically saying what you estimate the improvement of the performance is going to be. So if it's currently, let's say, generating $150,000 a year of income, the pro forma might be we spend $500,000 and then we change it from $150,000 of income to $210,000 of income per year. In the commercial real estate world, that improvement of income, even though it's only a $60,000 yearly improvement of income, that might improve the value of the property by well over $1 million. Well over $1 million in some cases. And then there's also depreciation and tax benefits of being part of a syndication. Private equity funds are very similar. Private equity funds have a tendency to have higher minimum investments and are going after very, very large investments. They're the ones going after the 1,000 unit plus complexes. And they may have a $250,000, $500,000 minimum investment amount. All right, so next. How do you decide what to invest in? Does any of this sound overwhelming so far? Or does it all make kind of sense?
It's pretty overwhelming.
Yeah. It's like anything, it takes a little time to get used to the verbiage of it and to wrap your head around it. Sitting down and going through some of it and just practicing it makes it a little bit easier. And I'm a big believer in figuring out what it is that you want to accomplish and then kind of putting the blinders on to everything else. And so how to decide? So create a plan with the end in mind. A lot of plans are based around, I want to make more money. It's not very specific. If you say, well, every year I want to acquire 1 new property, or I want to add $500 of passive income per month every single year, then you can start getting specific about what that looks like. If your goal doesn't match the criteria of what's available around you, Then you have to decide, well, do I want to change my goal so that it matches what's around me? Or do I want to change where I'm looking so that I can invest in something that makes my goal make sense? One of my past clients who we worked with a handful of times, his goal was that he wanted a 15-year note on every investment property. That way it would be paid off before he was retired. And he wanted a net $500,000 a month on the properties with the 15-year note. And we were able to help him get a couple of properties in Denver, and then the market priced him out. It was no longer an option for him to be able to get a 15-year note and pay it down. Though if you read that book, The Banker's Code I mentioned, they basically say you should never pay your real estate off. You should always have leverage because the arbitrage on it is so important. So 4 investor profiles. So the investor loves the opportunity and buys the right thing. The collector loves the ownership, buys something. The speculator loves the action and buys anything. The observer loves the ideas but buys nothing. It's very normal to be an observer for a period of time until you get comfortable, and it's usually in the form of educating yourself, either witnessing somebody in your world buying and selling and them not losing everything. The speculator, we've had a lot of speculation. I'll be totally honest, like I've gotten caught up in speculation. I invested in assets like cryptocurrency stuff that just absolutely tanked. And it's easy to see it when things are going up like that to put a certain percentage in. Yet as long as you're investing based on your overall portfolio mindset, that maybe that's 5% of your money you're investing or 10%. Who are you listening to that could be a great mentor on that? I am a huge fan of Ray Dalio. If you ever listen to Ray Dalio, he has a book called Principles, which is one of the best books I've ever read in my life. And he really dives into principles of life and work and his strategies. The strategies that he implemented were able to make his hedge fund the most successful hedge fund in America. And now he advises countries. So get on figuring out what this might be. It may not happen alone. It may take time. It may take sitting down and having conversations with a real estate advisor, a financial advisor, a tax advisor. Obviously anyone else involved in the investment, if there's a spouse or family member or whoever else is putting money in, to figure out what that may be. Yet the goal is to help everybody move from that observer phase up to this investor phase. It's okay at some point to be a collector because you might decide to buy a property that isn't an amazing return, but it gives you a great lifestyle return. Mountain properties, some cases are those. Some mountain properties are an amazing investment. Some, they pay for themselves and they're a good investment, but they're not making the same monthly cash flow that you could make on a property in Kansas City. But then again, you probably don't want to take a vacation to a little $80,000 house in Canyon City, where you may really want to go to the mountains. Like we're building a mountain house right now that'll be done in a couple of months. And part of it was with that collector in mind. Part of it was a little bit of a speculation in mind because we didn't know what the market was gonna be doing 2 years after we put our deposit down. Fortunately, it is up pretty significantly. It's up about 28 to 30% from what we paid for it. So we can close on it and just resell it and make a big profit. And we're structuring right now, maybe we close on it and sell 50% off. Maybe we sell 75% off so we still retain use of it, but now we're getting our capital back, and even then we'd rent out the other part of it. So we're structuring that now and we've got time to do that, and it's just getting creative. So, next slide. Source of capital. Oh, did we skip one? Yep. Source of capital. So this is the thing that usually holds people back, is they're not sure where the money's gonna come from. They're not sure what they can do to be able to afford a property. It's pretty normal. I mean, my wife and I, when we met, we were living in Los Angeles. I was working as a banker, she was working as an attorney, and we didn't even consider buying a property because it just seemed like it was so out of reach. Even though I was in the banking world, it seemed like it was just out of reach and it made more sense to rent. I mean, that being said, the first deal I did in Denver back in 2008 was helping a friend that was a banker buy a $610,000 property in Hilltop, which he later sold for like 1.4 million. And the reason he was able to do that was because him and his wife bought a condo. Their mortgage payment really wasn't any more than our rent payment was at all. The only difference they did is they chose to not go to as many dinners, not do as many vacations, not do as many things to spend some of that disposable income. so they could get their 3.5% down payment and acquire that property. Owned it for a couple years. That was enough of a down payment that when we bought our first property here, we were buying a $130,000 property and they were buying a $600,000 property, even though our incomes were relatively similar. But the down payment made the difference. So earned income is where most people start. Mortgage, of course, is going to be a huge source of capital. Most folks are not doing 100% cash down. Equity from a sale, just like the example I said. A lot of people will take the equity from the property that they're selling to purchase their next property. Equity from a HELOC. Who here knows what a HELOC is? Yep. Home equity line of credit. You're basically pulling some of the equity out of your house. And here's one of the most amazing things about a HELOC or like syndications is that when you refinance a property and pull money out of it, guess what doesn't happen? No tax. So, you guys know who Jared Kushner is? Yeah, love him or hate him. He took his net worth from $3 million or $30 million to over $300 million and paid like $2.6 million in taxes because he utilized legal IRS strategies to roll from one property to the next. When he pulled income out, he pulled it out in the form of a loan. I mean, I was at an investment group recently, and one of the gentlemen who's younger than I am talked about how in 2021, he pulled $8.6 million in income out of his investment properties just to sit on the sideline and buy more properties and also redevelop a little farmhouse he bought in Greenwood Village on 2.5 acres. So there's ways to, your IRA, this is one that a lot of folks don't think about, that you can actually take your IRA money, and the IRS has gotten way better at allowing it and a lot more clear on how to structure it. You need to have a third-party administration system. If you've got some money sitting in a 401k, any kind of IRA, and it's just sitting there, and you want to try and invest in real estate, you can do what's called a self-directed IRA. You can't do it on a personal residence. It has to be on an investment property. You can lend money to someone else. That's a great way to do it. Lend money in the form of a hard money loan. You can purchase properties in an IRA. It's a little more difficult because you have to have 35% down. It has to be a non-recourse loan, which non-recourse means that if you default on the loan, the bank cannot come after you. They can only come after your IRA. And that's why it has to be 35% down, because it has to be able to pay for itself from the rental income, not just your income. So, source of capital, private investors. When I first moved here in 2007, early 2008, one of my fraternity brothers, who was kind of an advisor to our fraternity, went to Yale, he didn't go to Pepperdine, but he was an advisor at Pepperdine. He left his business doing commercial real estate and immediately went to Phoenix and started buying houses. And when I talked to John, at first he had bought like 60 houses. The first 5, he proved his model, and then he just went out to everyone he knew with money. Well, John ended up buying like 286 houses. They started selling those houses in 2014, and by the end of 2017, him and his partner each retained 30 houses that they owned free and clear. They had each made a few $1 million. Their investors who gave them money to invest also made millions of dollars. Now John and his family live in Costa Rica. So it's a good win for them. And then source of capital, hard money loans. Who's familiar with what a hard money loan is? Myers, you know?
Don't.
Okay, be a good learning thing for you. So a hard money loan, you're not going through a typical financing process. They're investing on the asset typically. Some of them will have a personal guarantee. The rates are a lot higher, but it happens a lot quicker. Where a normal loan might be 30 to 45 days, a hard money loan is 7 to 14 days. A normal loan, they don't want you buying a property and selling it in less than 6 months. So we're here in this amazing office of Cross Country Mortgage, and the worst thing you could do is have a lender give you a loan and then sell the property 3 months later, because they have to pay all the income that they made on it back if the loan is refinanced or closed within 6 months. Hard money lenders are not the same. So right now, hard money lenders, it's pretty common that they're gonna want, if you are an experienced investor, they will invest up to 100% of your purchase price, but they need to have an appraisal, they need to see that you're buying it at a discount and there's equity. They need to have a clear path on how you're gonna fix it up. If you're a new investor, most of the time a hard money lender is going to want anywhere from 30 to 50% cash down. A lot of new investors who get into flipping, the way they do it is that they get private investors to invest money with them for the down payment, and then they get a hard money loan on top of that. So the private investors might make like a fixed rate of return or a percentage of the equity when they sell it, where the hard money investors, they're making interest. Usually it's an interest-only loan, anywhere from 1% to 3% fees upfront. So if you're doing a $100,000 loan, $1,000 to $3,000 in upfront fees, and then you're typically paying about 10 to 14%. Occasionally you can get it around 8% if you're an experienced investor. Most of them right now are around 12%. So just think about 1% per month. So if you're $100,000 example, you're paying $1,000 per month on it. Some hard money lenders will also let you put all of those payments in the back end. Some of the savvier ones will do that, because then every month they add the interest onto the principal. And so then they're charging you based on that month's principal. So if you start at 100,000 and there's the 3% fee, well then they're gonna bump you up to 103,000. And so then your first month, you're paying them 1% of 103,000. And then the second month, you're paying them 1% of 103,000 plus the first payment of 1% on that, which would have been, what's that, like 1,030. So you're adding additional extra dollars on. It may not seem like a big amount, but if it's a 6-month transaction, that means that investor may have earned an extra $600, $800. And if that investor does that over and over again, the hard money lender, they're winning. Ideally, if you're the investor borrowing that hard money loan, well, you're looking for a massive appreciation that's going to give you $20, $30, $40, $100,000 in gain. So you're not necessarily worried about losing out on another $500, $800. I mean, one of the best things I ever learned is that money doesn't grow on fees. So you always want to walk around looking at what fees you're paying. And then over time, what's going to happen is that all the money that you're spending to invest is coming from money that you're actually working for. Yet you will start getting to the point where your money is now earning so much on its own that it can acquire more properties. So again, one of my mentors started out doing this where it was all his own money. Now he can acquire between 2 to 4 properties a month just on the passive income he's earning from his other properties without even doing refinances. When you're pulling in a couple $100,000 a month in passive income because you've just built it over time, it doesn't happen overnight. It's not a get rich quick scheme, but it's amazing what it can do for you over time just with consistent base hits. All right, next. So this is a little quadrant that I personally use. A lot of this stuff is coming from the Millionaire Real Estate Investor book. If any of you guys have not read it, let me know and I can get you a copy of it. It's a fantastic book. It was written 20 years ago, but the principles are still fantastic. When you're looking at building your cash flow and you're building your wealth, so for example, if you're gonna be buying a property in Wash Park, Wash Park's a phenomenal neighborhood. Almost doesn't go down ever. Like land value alone right now is $850,000 to $1.25 million, unless you're on the park and the land value is $2.5 million right now. There's almost no cash flow in Wash Park, or you might have negative cash flow in Wash Park, but you very much get appreciation. New York's another good example. San Francisco's another good example. Though I mean, San Francisco's been a little iffy. You'll get a lot of appreciation, but you won't get cash flow. There's parts of Ohio where you get 20% cash flow. There's parts of Mississippi where you get over 20% cash flow. You will get no appreciation though. Lots of cash flow, no appreciation. But maybe that doesn't matter to you. I mean, there's college towns in Illinois that you can get 18 to 23% return over and over. You buy the property for $70,000 now, you sell it in 5 years, it's gonna be $70,000. Not going up, but you're getting a great return on it. Ideally, you're getting a combination of both. Yet there's strategies on each one of these. There's even strategies on investing in properties with no appreciation and no cash flow. Why would you invest in a property with no appreciation and no cash flow?
Deduction.
What's that?
Tax deduction.
Very good, very good. So there's a gentleman who, his main company's in town here, John Malone. Have you guys ever heard of John Malone? Or no? Founded Liberty Media, owns part of the Atlanta Braves. He owns part of a lot of things. He owns over 2.4 million acres in the United States. He's purchased properties, he's purchased businesses. Like he bought a business for over $600 million. They gave him a $900 million tax deduction. Or dollar for dollar tax deduction, not like a deduction to reduce your income. He saved $900 million in taxes because he bought a business that was down. Real estate, you can do the same thing. Conservation easements is one way. You can buy a piece of land. Basically, you're committing to never develop it. It can never be built. It could still be used for like a tree farm or some certain types of farming. The best example I ever heard about, and I learned this from a CPA named Brian Muya, who's out of Atlanta. He came and spoke to us at one of our mastermind groups. Gentleman bought a just over an acre piece of land right off of a golf course, and they found out that it could be rezoned for multifamily up to 10 stories high. Could. Not guaranteed, but it could. Well, the appraisers that work on those kind of properties, that work on doing these, locking up the land for a long time, they're going to appraise it based on the highest and best potential future use. Just over $1 million to purchase the property. They got a $9.8 million evaluation for the future appraised value. That means $9.8 million of tax deduction, which leads, if you're in the highest tax bracket, that's about a $4 million tax deduction. The investor who bought it for 1.1 million, sold it to somebody who needed a tax deduction, sold it for $2.5 million. Doubled his money. Guy who bought it for $2.5 million, saved $4 million in taxes. He will never get appreciation, he will never get cash flow from it. Boom, $1.5 million savings though. Pretty good win. Next. So, real estate investing criteria. There we go. So, there's no right or wrong. All that matters is it fitting the criteria that you're going to be comfortable with? At the end of the day, you need to be comfortable with it. Take a lot of information from other people, but you really need to just do that to build a foundation and then decide for yourself. And it's not always easy. I'll be the first to say that, like, I'm very good at R&D, rip off and duplicate. And yet sometimes I'm doing that because I see someone else winning at a really high level, yet it doesn't line up with my world. We may not have those properties available here. I may have a different risk tolerance. It's not something that long-term I'm comfortable with, whatever it might be. So think to yourself, like, what are the things you really want? And in this order, like, location is gonna be huge. That's usually, eventually as you get more experience, location doesn't necessarily matter to you. Location is more of a tool that you use to get the right criteria to meet the right returns. In the beginning, most folks invest in the property that they built and they own. Type of property. Some people really like condos. Like, we have a past client who owns over 70 condo units in Aurora, split between 3 buildings. He's on the HOA board for each one of those buildings. His average purchase price was about $15,000 per unit. The average unit now is worth about $130,000. He just cashes checks and goes to HOA board meetings. Yeah, he's living a pretty good life. You gotta look at the economic conditions. Huge economic impact. So Denver's had massive growth. Side effect is we've also had price appreciation. 5 years ago, I heard of Huntsville, Alabama. Any of you guys hear of Huntsville, Alabama? You grew up down in that area. Well, Huntsville, Alabama happens to have a massive NASA facility going in there. And the side effect of that is then they're also getting other big businesses moving in there. So single family homes went from 70,000 to 100,000 to 120,000 to 180,000 to 200,000, all within like a 5-year period. And because it's economic driven, it's jobs driven. It's actually justification for that value there. Construction bases. Like, I have some investors I work with that will only buy hardened concrete and steel buildings. That typically means 5 stories or more. They don't want to deal with a building falling apart. They just want it to last longer than they will. So I know some people that only like to get kind of crappy buildings and then fix them up. It's very common to do that. The features of the property and then the amenities of the property. So when you're defining and refining your criteria over time to know your criteria, it's going to have to do with the property is a big part of it. The people in your world is going to have a huge impact on that though. the network that you're able to lean on and grow is gonna have that. Our goal is to be able to provide a lot of value to our people so that our network becomes your network when you're working with us. Suspects and prospects. This is the things that you're looking at and the things that are actually turning into real opportunities, which you can then acquire. But when you know your criteria, it's really easy to not go down a rabbit hole and you're just staying within your ecosystem and world. So it's really important to figure out your criteria. Next. Okay, so there's different philosophies on where you should be buying in the market. I definitely agree with this in a lot of ways. Even the property that we're building in Silverthorne, it's a very nice property. And there's properties down the street that are selling for 5 times the amount. So even though it's more expensive than my primary house, and it's a beautiful new build property, it still is living over here compared to the ones over here that are the top of the price point for the area. That might mean if somebody's investing in, like I've got friends who invest in LA, and the garbage properties they're buying are in the 5 to 7 million range because they're in neighborhoods that sell properties for 20, 30 million. They're buying a property that needs to just be torn down for $5 million. But that's what the market can demand. So when you look at that, like whether it's Aurora, whether it's Castle Pines, whether it's Fort Collins, if you look at the good deals versus the great deals, most of them are going to exist in this world. Some of the best properties that we've helped our clients invest in that were first-time home buyers were in neighborhoods like Athmar Park, neighborhoods like Baker, that used to be kind of sketchy after a certain time. The crime rates were a little higher, properties were dilapidated. I mean, we helped folks buy in Athmar Park that were like, 6 months after we were in there, we saw like a SWAT team take somebody down like a block away, but then they were able to get a house for $180,000 that currently sells for $500,000. They got in when it was considered a great deal, and then it's moved up and now it's in this range. It's still a good deal, it's not a great deal because they rent well. So, any questions on that? Factors for investing in real estate. What investment purpose? Your expected cash flow. New construction or existing property. I mean, this is something, when I first learned about investing in real estate, it was from a fraternity brother in Temecula who put a $5,000 deposit down on a property for $320,000, closed on it for $320,000, sold it 3 days later for $450,000. He did it 5 more times, got caught pretty bad upside down on the last 2 of them. So that was a speculation. Looking at the valuation of the property, what kind of value can you add to it? Like Ryan and I looked at a property recently that they were willing to sell for between $400,000 to $450,000 in Mayfair, walkable to all like Trader Joe's and all that stuff, but it had $120,000 of structural problems. And it had a layout that wasn't conducive for getting it into a nice high price point. So even though there was a lot of upside, the risk associated with it, $250,000 of investment into a property that might sell for $800,000, or it may just sit on the market because it's only got 2 bedrooms upstairs. Looking at your credit score, that's going to determine a lot about what you can invest in, your property location, overall real estate market, and then the leverage that you use. And next. So personal investing advantages, we talked about some of these. $500,000 in tax-free gain possible every 2 years, $250,000 in tax-free gain possible for single people. This is something that, again, being in the real estate world, I am going to heavily encourage my children to do this, even if it means I'm helping them fund their down payment. Now my wife and I are at the point where we would consider this. For a long time, we had no desire to make the move over and over again. We really liked our spot. That being said, we walked away from maybe $1 million or more in upside on a couple of properties because I saw the property, like one that backed to Cherry Creek Reservoir, and I'm like, ooh, this $560,000 property that's dated and looks older inside than I do, like this can be fantastic. Last time that property sold was $1.4 million. Another property we looked at that would have been just under $600,000 in Greenwood Hills, last time it sold was $2.2 million. Granted, there was probably about $500,000 of improvements to it, but if you make that opportunity, moving is not fun. We're in the business of helping people move, and it's considered to be one of the 5 most stressful things in someone's life, along with like having a baby, getting married, divorced, losing a job, getting a job, losing a loved one, things like that. Low down payment, big advantage there. Huge advantage. Next. So the goal with any time you're going to be purchasing a property is that you're either getting into something that has a lot of improvements, or else you're getting into something that has low noise, meaning it's just immediately turnkey. You've got a fantastic, and that's something that we've talked about doing for investors. One of my mentors, his company has done over 5,000 units. It's called Memphis Invest, where they will actually buy the properties that are not inhabitable, renovate it, put an awesome tenant in there, and then sell the turnkey property to an investor. And so they're making a premium for their services. The investor's getting an awesome property that's ready to go, durable materials, good tenant in there already vetted for them. And so if you're looking at any of this stuff, so like your initial profit, depending on where you're investing, you're spending money, so your profit's going down, but then like the best improvements, you wanna make sure you don't over improve it. It's a fine line with over improving. You wanna have quality materials, but depending on the use of the property, if it's like a rental property, you wanna make sure things are durable, but it doesn't necessarily need to be fancy. Or if you're trying to get a single family owner to buy it as their dream house, you wanna make sure it has some fanciness to it. So like that might determine if we're flipping a property, do we get the lights from the Galleria of Lighting, or do we order it on Amazon? Do we get the tile from like Bedrosian, or do we get it from Floor & Decor or Home Depot? Are we using real wood, or are we using LVP? Actually, most of the time we just use LVP now. Even in high quality properties, they're using like a higher version of LVP. You guys know what LVP stands for? Luxury vinyl plank. Looks like this stuff right out here. That's a very high durable LVP. Looks nice, but you can really beat it up. All right, house hacking. The definition of house hacking means finding ways to generate income from your home. Traditionally, house hacking means buying a multifamily property, living in one unit, renting out the others, so the tenants pay the owner's mortgage and the owner builds equity while maintaining the property. Make sense? I'm speeding up on some of this because I know we've already talked about a lot of it. So going back to active real estate investing, next one, buy and hold long-term leasing. There can be some great advantages to buy and hold. You get great depreciation. Buy and hold, long-term investment strategy. Investors purchase the property, hold on to the property for an extended period of time. The owner typically intends to sell down the line, but will rent out the property until then, and will help with the buy and hold and real estate financing. The great part about this is that it's like an annuity. You buy a property for $500,000. It's a $400,000 loan. Well, if you keep that property for 30 years, it's now got a zero loan. You can sell that property, and that $500 property after 30 years may have appreciated a Lord knows what. And then if you want to sell that property, you can, and pay no tax as long as you roll it into another real estate asset. That's called a 1031 exchange. Or you can refinance the property and pull cash out, take that money to buy the next property, keep your asset, and just keep them growing, keep them going. Active real estate investing. Biggest perks of any real estate strategy is the potential stable monthly income returns, and there are benefits to be aware of, and there's challenges. So some of these long-term appreciation for long-term investing, numerous tax deductions. Real estate can offer your portfolio some protection as inflation increases. That's a big one. That's going to continue to be a big one for a while. And of course, there's a few drawbacks. Real estate takes longer to sell. It's less liquid. Property management will require some time, or at very least a reputable third-party company. Plan on paying in the Denver metro area, depending on how many units you have, between 6% in management fee to 10% in management fee for a long-term rental. If you only have one property, then you're probably not going to get too much better than 10% for like a good full-service manager. But as you start getting more properties, especially multifamily, then that goes down. Real estate moves through multi-year cycles, and so you just have to be aware that depending on when you need liquidity, you may be in a cycle that lasts another year or two, or 3 or 4, and you'd be selling it for less than you want to. Buy and hold short-term vacation rentals. Advantages, you get great earning potential, like often 1.5 to 3 times the standard of long-term rentals. I mean, think about that. A property that rents out for $2,000 a month, long-term, might get $6,000 a month or more in short-term rentals. The challenge is that you're not renting it 100% of the time. We'll get to that in a second, but flexibility. So like our first mountain property we did, part of the flexibility is that we used it anytime other people were not using it. And you can do that. Less wear and tear. This is one where it's kind of funny because yes and no. Less wear and tear because you don't have somebody that you're not witnessing in the property. Every couple of days or every week, you've got cleaners going in there and sprucing it up again. So it has less chance just to have that slow, gradual, long-term decline. That being said, like the last property we sold it furnished up in the mountains. And the investor bought it, who lives close to where we do down here. She's reached out to me like 7 times already for broken furniture and stuff. And we bought pretty quality stuff, but it's amazing what people can do to break things. And so you just have to know that there's going to be some wear and tear on things like that. You get the appreciation deductions. You don't really control the renters. The lady who bought it off of me, she was telling me that like the first renters they had, one of them you could tell they were hardcore skiers, because I installed all this stuff in the house where you can see if all like the doors are open and what lights are on and off. Because we did that so that when we were driving back, if I saw lights were on, you didn't have to turn around and drive back or leave lights on for the next 2 weeks. She was like, I thought it was funny that the first renters, the lights were all off by like 8:30, and then we're on again in the morning at like 5:30. These guys were doing backcountry in the morning and then going to the ski resorts. And she was like, and then the next renters were like, they're like, oh, we're family, we're not gonna go crazy for like New Year's. And at 4 in the morning, doors and stuff were opening and closing. There's some pretty incredible things you can get now. Some of the property management companies can actually put these tablets in there that give all the instructions, and then they also have a decibel reader on them. And so if the decibels are over a certain level, the people renting it get a notice that, hey, chill out a little bit. If they don't respond to that, then they get a phone call. If they don't respond to that, then they actually get somebody to show up, whether that's the property managers or whether they actually just call the police to say like, it's like, they call it like their anti-party features. And it can't hear anything. It can't like, you're not picking up any noise of what they're actually saying. All it is just straight decibels. Disadvantages, little control of the renters, lack of predictability, time consuming, higher management fees, and higher taxes. And this one right here, so the management fees, if you can use a company called Evolve, that's a 10% management fee, but then you do still have to coordinate all of the workers going in and out, and you're paying for that. You can use a full service management fee, which in the mountains is oftentimes between 25 to 35% of what your net income is. That's a lot. So you may make 3 times as much, but then know that the amount that you're paying on management fee may also be 3 times as much. Taxes are also higher. So depending on what municipality you're in, if the average rental rate or average rental term is less than 30 days, you may be required to pay hotel occupancy taxes compared to just on top of normal income tax. So like we've got some good friends who bought a place in Steamboat. All winter long, they rent it out short term. They ideally limit it to a week. People are in there a week. But then in the summertime, they've got one guy who rents it for 4.5 to 5 months at a clip. And so it makes it so their average, they always make sure that their average is 30 days because then they avoid paying that occupancy tax. All right, next. Rental property analysis. And I'm gonna go through some of this stuff pretty quickly because we can get really in depth on this and we're gonna save it for another time. But cash on cash return, that's like talking about like if you put $100,000 down in a property and the property goes up 20% example and that makes you $100,000, well then your cash on cash return was 100%. Your cap rate, this is a term that people use a lot. You can just equate that to your percentage of return. Like if stocks go up 15% a year, that'd be like saying the real estate property may have had a 15% cap rate. But it has to do specifically with your net operating income before mortgage payment, market divided by your market value of the property. So oftentimes, like an easy example would be, if a property rents out for $1,000 a month, it's a $100,000 property, well then you generate $12,000 of income from it. That's a 12% cap rate, 12% rate of return. So you take 12,000 divided by 100,000. Gross rent multiplier is your market value divided by your annual rents. Gross rental yield is gross annual rent and market value. The other thing that often comes up is what's called DSCR, which I should have had on there, which is debt service coverage ratio. A lot of commercial properties, they want to see 125 to 135% debt service coverage ratio for their loans. So that means if it costs you $20,000, or let's do a round number, if it costs you $10,000 a year to pay the mortgage on it, they want to make sure that you're generating $12,500 to $13,500 in rent minimum, or they may not even consider giving you a loan. And so you have to do more down payment in order to hit that number. So when the rates started going up, I had a client I was working with, and we were putting offers in on 300 plus unit buildings that were in the $30 to $40 million range. And all of a sudden the amount of money he had to put down went from like $9 million to $15 million in order for the banks to hit that debt service ratio. So interest rate can definitely affect that a lot. Here's an example of one. We have a lot of different tools. This one I pulled off the roof stock. Whenever you're looking at a real estate investment, highly advise you spend enough time to even understand this Does not mean you have to do it though. You can hire real estate professionals like us, and then eventually you hire your bookkeeper and accountant to be able to walk you through numbers like this so that you can see what's the expected return. And then what's really especially important is to go back and actually check how it's performing compared to what you thought it was going to perform. It's amazing how often we find that what we think we're going to get and what you actually get are not the same. What I find in the multifamily world is a lot of times the investor who's selling it will try and improve the property as much as possible in the 3 to 6 months before selling it. And you may have a couple of years of income like this, and then all of a sudden it jumps up like that. And then they're trying to sell it like that, but they may not necessarily be including everything. Or they may, like this was a fun one we discovered. We submitted an offer, we had an LOI in, a letter of intent, and then they told us what the rental rate was. Only to find out that the leases that they provided for us to review, they were 12-month payments, but the tenants got 14 months. So they were selling it based on a 12-month payment, but we had to give the tenant 2 months free at the end of their lease. We're like, hey, this cap rate you're selling is not what you're selling. And the broker was like, what do you mean? We're like, are you guys gonna cover the free month's rent? Because we're gonna get stuck with it. All right, next. So here's an example that came from the Millionaire Real Estate Agent of some check boxes that you can look at for your criteria worksheet to help you narrow down what you're looking at. So that you know what you're getting into and then you're not getting surprised. Of course, with any of these, you wanna make sure to have really good inspections, especially with Denver now, because you're gonna be required to submit an inspection to the city and the county. Next. Getting your investor network up and running. This can be overwhelming when you look at this at first, but know that again, it happens quickly over time, and it starts usually with partnering with somebody who is like where we are because we know a lot of these folks here. Like you need to have your partners that are investing with you, your mentors who might be guiding you, consultants that you can hire. That would be your inner circle. Oftentimes the realtor is part of the inner circle. I know I am with a lot of the people that I work with. The support circle, all the people who are potential vendors to help you out there, and then your service circle, all of those folks. You don't need to have all those people there. You need to have, like a lot of times, like your property manager, they're gonna know a lot of these folks here, like insurance, concrete, masons, stuff to take care of it. Next. Here's part of the financial model. So if you look at over time, when you buy it right, you pay it down or pay it off, you go from having this vacancy and expenses, you always wanna count on, at some point, you're gonna have to turn the property over. Renters will only stay there a certain amount of time, and then when they move out, maybe you can time it perfectly where another renter comes in, but most of the time you might have a couple weeks or a month of rent that you're not collecting. My advice to every investor is to have a minimum of 4 months of rent and all expenses saved for that property. When the last market crash happened, one of my good buddies owned 58 properties in Denver. And he thought he was like golden. Problem was he bought a lot of those properties with zero money down. And as soon as he got to 16 tenants not paying their rent, it just started becoming a domino because he didn't have enough money. He had like jet skis and a really fancy house, but he didn't save enough money. And so he ended up losing almost all of those properties because he didn't maintain enough to debt service the properties, assuming the tenant wasn't gonna be paying. So yeah, you look at your vacancy expense, your debt expense, and over time, the amount of cash flow is gonna go up. Boom, 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 until all the way at the point where your debt's gone away, your cash flow goes up because over time rental rates do appreciate. Passive real estate investing, stock, mutual funds, ETFs related to real estate. So real estate stocks are companies that own and operate real property, and that can even include oil companies, especially ones that are in mineral rights. That is considered a real property asset. That includes real estate investment trusts, a special category of public companies that own real estate. Investing in real estate stocks can provide your portfolio with a stable income advantage and tax advantages depending on the investment type. So I know a lot of folks that that's a great way of investing with their 401ks if they don't have enough assets to necessarily lend out to someone. Historically, real estate investment trust REITs have outperformed the S&P 500 by about 0.7%. So REITs have performed about 10.2%, where the S&P is about 9.5%. Next, publicly traded REITs and private REITs. So what's a real estate investment trust? It's a company that owns, operates, or finances income-generating real estate. Modeled after mutual funds, REITs pool capital from numerous investors and make it possible for individual investors to earn dividends from real estate investments without having to buy, manage, or finance any properties themselves. So I was very fortunate to work with some clients who were with they manage a REIT that's publicly traded, and they're a healthcare REIT. When COVID happened, what do you think happened? Do you think they got harmed during COVID? They really didn't, because the main thing they own is laboratories. And guess what? You can't work from home in a laboratory. You can't bring a $10 million centrifuge home, or like all the microscopes and the things that they do. And so it can be a great way to diversify investments. Most investors, we're not going to necessarily be able to buy into an $80 million project. We may not even get the opportunity, because even a syndication may require a pretty high investment down payment, where some of these REITs you can buy into at like $20 a share. So just something to consider with a balanced portfolio. Crowdfunding real estate loans. Crowdfunding is used small amounts of capital from a large number of individuals to finance a new business venture or property. Crowdfunding makes the easy use of accessibility of vast networks of people through social media and crowdfunding websites to bring investors and entrepreneurs together, with the potential to increase entrepreneurship by expanding the pool of investors beyond the traditional circle of owners, relatives, and venture capitalists. You know, there's a lady that I follow on social media. Her name is Investor Girl Brit. And she moved like 2 hours away from her city because she couldn't afford to live in her city, bought a garbage property and renovated herself. And then she did it again and did it again and did it again. And she recorded all this, and she got a big following. Well, because that following, somebody approached her about developing a storage unit facility. And at the time she was like, I don't have the money to develop this $5 million storage unit facility. She went out to her network of people that were following her, which I think at the time was like over 10,000 people. And she didn't need to get a minimum investment amount on how she structured it. I don't know how it was, but she was taking investment amounts that were anywhere from like $5,000 to $10,000. Now she's Investor Girl Brit, who specializes in developing storage facilities, and they own like 3,000 storage units. Because of that crowdfunding, instead of getting one or two investors, she had hundreds of investors invest in the project. They all made their return. And so it's just something to consider. Passive real estate, private notes. This is where you acquire the note for cash flow, acquire a property and sell it for seller financing. Real estate notes are created when a property buyer finances the purchase of their property through a mortgage loan, but the mortgage note is often sold to an investor. Most of us, anyone who's bought a property before, it's pretty normal to take the loan out with one bank, and then a month or two later, all of a sudden have another bank is the one sending you the payments. And this is just a way where you, as the real estate investor, can do this. You can be the one who's doing the notes. Next one. The syndications. Real estate syndication is a group of two or more investors or investment companies coming together for a common goal. It's usually raising capital to buy a big property. That's something that we're going to start working on as a team, because we've encountered some great opportunities before that we were not able to make happen because we weren't sitting on the extra couple $1 million that we needed. Yet pooling it together, let's say a 300 unit building with 10 investors, well, when you divide that up, I mean, that's still a lot of units per investor, and it's a great way to make a potential return. The advantage of that is you get scalability. You don't have to go to multiple different properties. You can get one crew working on a property for an extended period of time. There can be some really big advantages on doing things like solar credits. Like, solar credits don't necessarily mean much to us here, but if you're in a place like Texas and you've got a big building, that may offset $70,000 a year of expenses for air conditioning by putting solar up there and get a big deduction for it. And that typically can only happen when you're working in large pools like a syndication. And then here's a couple of resources. We're wrapping up here. So here's 3 books that I highly recommend anyone and everyone start with. Ken McElroy is the one that I saw personally. Brandon Turner is actually from here in Denver, though now he lives in Hawaii. Gary Keller, Millionaire Real Estate Investor. Everyone here, we're gonna hand these little cards out. It's got a QR code on it. We'd love to get your feedback on what was good, what wasn't good, anything that you'd like to learn more about in the future. We are going to continue this series, but diving into each topic in a little more depth and starting to show examples of real life deals that either we've done or clients have done or ones that we're considering, so you can learn from it. And you can just take a snap of the QR code and fill out what you think of it. If you go to the next one, there's 3 more books that I recommend too, if you get past the first 3. So this one's a little bit more in depth. It's like Real Estate 2.0. The book on flipping houses, Mastering the Art of Commercial Real Estate Investing, and a book on tax strategies. And that concludes it. Though what comes next is actually a bunch of stuff about the economics, but we have definitely hit our time and we're over it now. And I want to honor that. So, what questions do any of you guys have? And anyone on Zoom?
Another book, bank, something.
What's that?
I believe you mentioned another book name.
Oh, the Banker's
Bank
Code.
something or something bank.
Yeah, the Banker's Code.
Banker's Code, thank you.
And actually, if you fill out that, I have a copy of it on PDF. If you want us just to send you a copy, so just fill out the information, and then be happy to send you that copy. Yeah, I've already made sure to send that to a bunch of my hard money investors so that they can learn a little bit more about how to structure financing, and may not have necessarily been for my benefit, more for theirs, but yeah, great question. What other questions do you guys have?
I'm kind of curious about finding a mentor, like how that works when
Yeah.
you don't have like a large
Mm-hmm.
group of people to reach out to.
Yeah, no, that's a great question. It's so like in my experience, like I would find mentors just by reaching out to people that I saw were doing it, going out to coffee meetups. There's REI groups in town, which is real estate investment groups. That can be a great way to expand your network and connecting with people like us that are actually working in it. Part of our goal is to guide people along. So like Chad sitting right next to you, has been on the team for years. How long have you been licensed now? 26 years. And he was an appraiser before. So finding people that have experience to kind of help guide you with it. Sometimes, so like some of the people that I've worked on mentoring are people that have invested with me in properties, where they start out as a passive investor, but then they're able to show up to the property whenever we're meeting contractors, whenever we're doing stuff there, and you just kind of learn from doing it. That's going to be, if I had to do it over again, I would have invested a bunch of money in other people's projects with the condition of being able to shadow them. What I did was spend a couple $100,000 on going to trainings and learning from people that are experts who are selling their packages. And so I used earned income to invest in education to then be able to do it. So, but that's a great question. Yeah, reaching out to people that you see. It's amazing how many people will respond too, like even if it's on social media and stuff like that. Most of the investors I've worked with are pretty cool, because most people have the mindset of abundance, that whether or not we're going to do business now, at some point we might in the future, and it's great to maintain that network. So, yeah, fantastic question. What other questions? Hopefully I didn't put too many people to sleep. All right, well, I very much appreciate everyone coming today. Please definitely leave feedback, and love any guidance on what you guys would like to learn from next. I can talk on this stuff for days with the years and years I've been doing this. And so we definitely are going to be continuing this to dive in deeper. And of course, next time we have an event, feel free to invite anyone that you know, whether they can make it on the Zoom or whether they want to come here in person again. And I appreciate you guys coming, and hope you have a fantastic rest of your day.
Thank you,
Thank you,
Steve.
Steve.
Absolutely, yeah.